We know that India has been a massive player in the silver market. You can find quotes that it's purchased between 6, 7, 800 million ounces in the last 5 or 6 years. Copious amounts. We know that Russia said we're going to add it to our strategic stockpile, being one of the first countries ever to say that. We see massive deliveries. Talk to David Jensen on the COMEX, the LBMA numbers. Huge deliveries coming off the LBMA in a hugely rehypothecated market where way more contracts exist than bars standing behind it. To your point, we saw Saudi Arabia jump in, and I think it bummed a lot of people out that they bought SLV, but the amount that they bought in SLV allows them to actually stand for delivery. I think there are a lot more countries that have been doing this just on the down low than we are led to believe. You look at China as the second largest producer in the world, flying all around South America, going directly to the miners. Sean Kunkun has talked about this, CEO Dolly Varden, where they go right to the miners, disintermediating the marketplace, buying doré and concentrate right from the miners, paying double what the West will, and sending it back to China to refine it. They control the majority of all the metal refining and rare earth refining, so they just put it on a barge and send it on back to China. I think we're at a tipping point in the silver market, and I think you point to the growing shortage of physical supply at the highest levels, the LBMA, the COMEX, and now even the Shanghai market. They're all showing stress, if you will, in supply, and the amount of, or the number of deliveries is off the chart. And coupled with, surging demand for things like industrial, investment, central banks, sovereign wealth, the same stuff we've been talking about forever, man. Silver is being pulled from every direction. That's just the bottom line. And not enough talk about it anywhere except on the alternative media channels, so it doesn't gain any traction. But where you will start to see some traction, in my mind, is the fact that the U.S. government just designated it as a critical mineral. And to me, this changes the narrative. Silver is no longer just a commodity. It's a matter of national security, national strategy. And when you talk about the kind of potential that silver has, remember that in terms of market cap, it's the tiniest little nothing market. And when capital begins to flow in, like the United States government and the sovereign wealth funds, it doesn't move gradually, it will erupt at some point. I do believe that. But the bottom line, Jesse, is you got tight supply, you got surging demand at the highest levels, coupled with systemic risk and the LBMA and what could happen if we see a delivery failure, coupled with official recognition. I would say silver isn't just poised to move, it's ready to explode. And yeah, it has been catching its breath, and anything that moved that fast, 40% in a couple of months, is overbought. That's the definition of overbought, and it needed to correct. It did, and here we are back above 50 again. So yeah, I say buckle up for what's coming next.
On the demand side, silver is being pulled from multiple vectors: industrial uses in clean energy technologies and electronics, strategic accumulation by central banks and sovereign funds, and renewed interest from investors as a hedge against macro risk. For instance, the solar panel industry and electric vehicle supply chain increasingly require high-purity silver. When combined with traditional investment flows and strategic metal accumulation, you have a potent mix driving structural upward pressure.
Look, I'm not trying to be anything other than honest. Either many of the things I say, people could say I'm stupid for saying them, or maybe I just have the courage to say what I believe. And I have been saying this on your show for a long time. This is confirmation of what I've been saying. The fact that the U.S. just named silver a critical mineral, along with China's tightening exports, there's no coincidence there. This is governments recognizing, I think, silver's strategic importance. Go back a year or two, Canada, many of the miners and players in the silver market in Canada tried to do the same thing, to have it reclassified a strategic metal, not an industrial metal. But this is an understanding, an awakening. It means a floor has been put under demand, number one. You have policy-driven buying now that will be coming in from the U.S. and from other countries like China, who will see that this is musical chairs, if you will. And at the same time, you have a global supply crunch. You got players getting squeezed, and you get China, who is, a big player in the silver market, limiting exports. Yeah, that's a big deal. Now, silver isn't just an industrial metal anymore, Jesse. It's obviously it's strategic, and it's monetary. It's essential. And I think now that governments are making that official, you know, I think from the highest levels, maybe governments just lit the fuse. So yeah, I think it's a big deal. It's a huge deal, bigger than just about anything I've seen in a long time in the silver market.
A key development: the U.S. government has officially classified silver as a critical mineral. This elevates silver's status beyond a commodity for jewelry or investment. It becomes part of national security and industrial strategy calculations. With that, policy tools like stockpiling, domestic production incentives, export controls, and trade measures become relevant. This reclassification signals that governments now actively view silver as a strategic asset, not just a precious metal.
But see, I think you answered your own question in the respect that we know that India has been a massive player in the silver market. You can find quotes that it's purchased between 6, 7, 800 million ounces in the last 5 or 6 years. Copious amounts. We know that Russia said we're going to add it to our strategic stockpile, being one of the first countries ever to say that. We see massive deliveries. Talk to David Jensen on the COMEX, the LBMA numbers. Huge deliveries coming off the LBMA in a hugely rehypothecated market where way more contracts exist than bars standing behind it. To your point, we saw Saudi Arabia jump in, and I think it bummed a lot of people out that they bought SLV, but the amount that they bought in SLV allows them to actually stand for delivery. I think there are a lot more countries that have been doing this just on the down low than we are led to believe. You look at China as the second largest producer in the world, flying all around South America, going directly to the miners. Sean Kunkun has talked about this, CEO Dolly Varden, where they go right to the miners, disintermediating the marketplace, buying doré and concentrate right from the miners, paying double what the West will, and sending it back to China to refine it. They control the majority of all the metal refining and rare earth refining, so they just put it on a barge and send it on back to China.
Beyond the U.S., global players are quietly moving. Countries like India have absorbed vast volumes of silver, while producers and refiners in China are consolidating control over upstream supply chains, working directly with mine operators and concentrating refining. Meanwhile, supply chains are global and complex. Miners, refiners, traders, and vaults are all interconnected. When you layer in export restrictions, import dependencies, and strategic hoarding, the system becomes more fragile, and a failure somewhere could reverberate widely.
But it's coming from the second largest producer in the world, so that should put a little bit of context into it. If they're making that much or producing that much, why fly all the way to South America to pay double what the West will to buy doré and concentrate and send it back for refining? I think you will see that. I think it's been there under the surface if you really dig. But I think a lot of countries, especially those in the BRICS, have understood that, silver and gold, this is a race for the world's commodities. And it's not just the precious metals, it's the base metals, it's the soft commodities. He or she who has the gold makes the rules, is how it used to be. How about he or she who has all the world's commodities makes the rules in the coming future? And I think that's what you're seeing. So, yes, I do think you'll see more countries and sovereign wealth funds probably at some point. It'll be more transparent what they're doing. But in a world where information travels so quickly, it doesn't behoove any of these players to let anyone know just how much silver they're gathering. And then look at the U.S. I don't care what anyone says. It ain't about tariffs. I've been saying that for a year now. It is not about tariffs. It is not about arbitrage. Sure, there's a little bit of that truth, but it's being reshored. And, I've been screaming this. Look, all this silver coming into the country can't just be about tariffs. That was the ruse to get it all back here. Some of it's flowed back to ease the burden at the LBMA. But what it really is the smart money trading ahead of the news. Like, they knew that this was going to happen. They knew that it was going to be reclassified a critical mineral. So what do? They reshore it. They say it's tariffs so that London releases it and Switzerland sends it. Oh, by the way, it's reclassified. I mean, everything that at that level that they do, you look at all the massive gold accumulation in 2016, 17, 18, and 19, and then the Basel III reclassification of gold. These things that at the highest level, information is worth more than anything. And the people accumulating it, the central banks, the sovereign wealth funds, they're not just the most well-funded. More importantly, Jess, they're the most well-informed. And I think that's really what you would expect to see, the inside money moving first. And I think we're transitioning to that point where it's now out in the open, at least more so than it's ever been. And at that point, it's anonymity be damned. It's everyone rushed to secure what they can while they can. So, yeah, I think you will see that.
Given the tight supply, rising demand, and strategic significance, the market is exposed to risk of failure to deliver, soaring lease rates, backwardation, spot futures, and the potential for major price moves. For instance, recent flows of metal from the U.S. and China into London eased a liquidity squeeze, but highlighted just how precarious the balance is. When contracts vastly outnumber bars and multiple sectors compete for the same physical metal, the result can be explosive rather than gradual.
It's very true, no matter what. It's very true. David Jensen does a masterful job of showing that. But in essence, they're trading, 700 or 800 million ounces a day in London. 2 billion a day if you add the COMEX and the Shanghai market. But in London, 700 or 800 billion ounces a day with a float of 150 million ounces. What could possibly go wrong? And so, yes, they are. And I mean, you can simply say the silver inventories are extremely thin, and the pressure is accelerating. It'll be much greater if China and potentially the U.S. curtail exports. Part of naming silver a strategic element is that the U.S. can now very easily, the president can restrict and curtail exports. And this sets the stage for a potentially explosive reaction if demand or the systemic stress accelerates. What is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. These banks are connected to everything financial. And so you would expect to see a contagion, a systemic reaction reverberating through all markets. But yeah, I mean, the truth of the matter is London has been exposed as far as I'm concerned. And they're hanging on by a thread. There's exponentially more demand than there is supply, and there's exponentially more contracts than there are bars. That is a powder keg waiting to happen.
While silver accelerates, gold remains a structural anchor. With gold trading back near record levels, driven by central bank buying and monetary stress, portfolios are being rethought. Analysts are now recommending gold allocations far exceeding the traditional 5% rule, but silver offers something slightly different: higher leverage, more industrial demand, and now strategic policy backing. For investors and market watchers alike, this combination of supply shortage plus strategic recognition plus investor interest may indicate we are approaching the next major leg for both silver and gold.
That I've never seen before in my career, and I've talked a little bit about this, but it's worth mentioning to your listeners. Look, in my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And, and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional trader. It's like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it gets takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone's saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation. Catching its breath, not throwing in the towel. Pick your euphemism. But the bottom line is gold isn't just strong, it's structurally more attractive than many people realize. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking.